Being a stock market investor has always been considered one of the best jobs one can have. And that's why this field is highly competitive and considered hard to understand or get into. Hello everyone, and welcome to Avid-Wisdom, and this is the summary of the book, called One Up on Wall Street by one of the greatest investors of all time, Peter Lynch. Before we continue, please make sure you like my video, share it with your friend, and if you have not subscribed to my channel, please subscribe for more such videos. One Up on Wall Street talks about the challenges of being a stock market investor, while also exploring how anyone can pick good, well-performing stocks without having much knowledge in the field, by following a few key practices. In One Up on Wall Street, Peter Lynch breaks the stereotypes related to what being a good investor consists of, and how anyone can beat renowned investors by using logic and common sense as their main analysis metrics. It all comes down to putting your money into the companies that you understand. Instead of researching analyst ratings and recommendations about businesses that literally imply rocket science to be understood, just keep it simple. When it comes to investing, overcomplicating it can ruin your chances of having a successful portfolio. Simple, everyday stocks can prove to be among the best performing ones. However, there are more aspects to consider when picking your investments, such as how to assess the value of a stock and analyze it correctly. There are certain traits that define what type of investor you are. It could be according to your risk tolerance, budget, and so on. However, according to Peter Lynch, there are also a few categories of stocks that you should know of before deciding where to put your money. Let's start with the first one, slow growers. These companies are usually large, part of a mature industry, and therefore grow slower. Stalwarts, they are a little bit riskier than the first one, as they're growing at a rate of 10 to 15% per year. Sell them if you make a 30 to 50% gain. Then, there's fast growers. They break the patterns and grow significantly, making them risky investments, as they can also lose their current price very fast. These companies can prove to have a high return on investment. When it comes to fast growers, always ask yourself, can it keep up with this growth pace? Is this sustainable? If you find that the risk is too high compared to the company's valuation, and that the market is just going crazy over it without a reliable reason, don't go for it. Then, there's cyclicals. These are companies that have their profits or losses move in concordance with the business cycle. One disadvantage of this type of stock is that they produce goods that consumers will postpone buying in times of financial uncertainty. Lastly, there's turnarounds, which are companies that have problematic balance sheets. Their stocks can prove to be a very rewarding investment if the business manages to bounce back and improve their financial status and management effectiveness. However, if the opposite happens, the risk of losing the value of your investment increases significantly. Let me conclude this video by saying, stock market is not some get-rich-quick scheme or something. If you really want to make a career in the stock market, treat it like a business. First learn everything about stock market. Then understand what type of investor you want to be. You can be a swing trader or a long-term investor. Learn before you earn. Thanks for watching my video. Hope you like the content.